The collapse of the U.S. housing market starting in 2007 nearly brought down the global financial system. Despite thousands of pages of new laws and regulations, government policy hasn't addressed the core issue, which is to restore prudent lending standards as the norm for mortgage lending. Historical experience back to the 1920s tells us how to promote stable housing markets and avoid crises. The key is to make sure that the large majority of mortgage loans are low risk. And by low risk, I mean loans that are very likely to be repaid not only in good times, but also in bad times. It's also important that borrowers have a lot of equity in their houses. That way, if they can't make the monthly payments, they can still sell the house and pay off the mortgage without the stain of a foreclosure. Since we can't count on the regulators to do the job, the best option is to provide lenders, borrowers, the financial markets, and policymakers with the information they need to assess the risk in housing and mortgage markets. To do that, we just launched AEI's International Center on Housing Risk. My colleague Ed Pinto and I are heading up the center. Our goal is to provide an unprecedented set of tools for measuring housing risk. The measures will be transparent, objective, and available in nearly real time. We've just released the first of these tools, the National Mortgage Risk Index. To construct the index, we take the loans made in a given month and ask how loans made in 2007 with the same characteristics actually performed after the housing crisis. The index tells us how well today's loans would withstand such a crisis were it to happen again. We find that although today's loans are of better quality on average than those made just before the crisis, fewer than half could be considered low risk. That's an important finding. It overturns the conventional wisdom that today's loans are pristine. I invite you to visit the Center's website to check out the Mortgage Risk Index and to learn more about what we're doing.